So what do you see is the end game with this just rampant spending out of Washington?
Kind of like the story of Cinderella. Spending works the same way. It's unsustainable. At some point, the clock strikes midnight and everyone has to face the music.
All right, ladies and gentlemen, welcome back to the Passive Cash Flow Podcast. I'm your host, Aaron Fragnito, and we have an interesting guest today on the Passive Cash Flow Podcast. We have Earl Yaokasin. How are we doing today, Earl?
I'm doing great. How are you, Aaron?
Oh, pretty well, pretty well. I wanted to have you on the show here as you are a certified financial advisor. You are an RIA, a registered investment advisor, and a man of many talents, helping other people build their wealth in a different asset class than real estate here, which is what I focus on. So we like to mix it up a little bit here and get some different types of professional investors on the show here. And but yeah, so why don't I just have you on here and give some tips. By the way, to our listeners and our viewers, if you're enjoying this content, be sure to like and subscribe and share with a friend if you're gaining value from our podcast. We have over 190 episodes here. We come out with a new episode every 2 weeks here on the Passive Cash Flow Podcast. We're on YouTube and all the major podcast platforms. You can check us out there. Get a little more at peoplescapitalgroup.com as well. But Earl, let's jump right into it here, my friend. What I found interesting about your bio there is that you also invest alongside your clients. Now, that's a crazy idea. Most financial advisors just sell some product or commission. You know, they make maybe they don't make a commission. I don't know. They may invest in this, that, and some widgets, some new technology, but they wouldn't dare put their own money at risk. From my understanding, you also invest alongside your clients. Is that the case?
Yeah, that's the case, Aaron. And one thing that's super unique about me and my firm is that 100% of my net worth outside of my emergency fund and opportunity fund is actually invested the same way as my clients. And there was actually a study done by Morningstar where half of all mutual fund managers don't even invest a single dollar in their own fund, which is absolutely bonkers. And I think it's extremely important for an advisor to invest alongside their clients because then they have skin in the game. That way, if they are recommending or investing this investment for their client, they've done a lot of research on it because if they lose money, their clients lose money too. And if they make money, their clients make money too. So they have every incentive as much as possible to make sure that they're picking the best investments for their clients. And of course, if the commissions are high for a specific product, then they're not going to want to recommend that product because they have to pay the commission themselves.
Interesting. Now, I talk to a lot of investors every day in my real estate syndication group here. And a lot of people are a little weary of the market. You know, they went up and down with the tariffs over the last first like 2 quarters here of the year. People are saying the market had a good run and there's no way it's going to keep growing this year. And it's a good time to sell, sell, sell. What would you say, Earl? Is it time to be selling or buying, or is that the wrong way to look at the market?
Yeah, I'll give you two perspectives on different sides of the coin. One is that there's no way that anyone can predict what the market will do in the short term. We do know, however, that in both real estate and stocks, that over the long term, investment properties and businesses will go up in value, generally speaking, of course. And on the flip side, however, you can also say there's this famous saying by Warren Buffett where if everyone is fearful, be greedy. But when everyone's greedy, be fearful. And what I can tell you is that over the last 15 years, actually 17 years now, the market has gone on a very strong run with a lot less volatility than it has pre-2008. So I do think that it is my opinion that I think the markets are very richly priced. I also think that despite stocks being super expensive, that there could be some events that could push it higher. The first event would be corporate tax rates getting cut from 21% to 15%. The other thing is that Jerome Powell's term is ending May next year. Whether he gets replaced sooner than that, we don't know. But if a new Fed chairperson takes the helm and decides to lower interest rates by 2% or 3%, broadly speaking, then that would be quite a positive for stocks, making things even more expensive. And that's why in the short term, we can't really say when the market would turn. But also, one thing that we've seen through history is that whether it's tulip bulbs in the 1800s, whether it's Latin American currencies, whether it's Japanese stocks, whether it's real estate in the US, like in 2008, all bubbles eventually burst. And I
Mhm.
do think that if the market does go higher in the short term, which, like I mentioned, it could easily do, I do think that the fall would be much longer and sharper. And one kind of hypothetical situation I like to make everyone think about is that imagine if you have $100,000.
Mhm.
At the end of 5 years, if that $100,000 grows to 160,000, let's say, and historically 40% drops, 50%, 60% drops in the stock market is very common. It happens every 7 to 10 years. And we haven't had one really, a 40% drop since 2008. So if your 100,000 goes to 160,000 and the stock market drops 40%, you're going to be left with 96,000. So anybody who, if that scenario happens, and there are multiple infinite scenarios, but if that scenario happens, you would be better off just parking your money in a high yield savings account, getting 4%. If the market drops 50% and 60%, then even more so. But of course, like I mentioned, we don't know when the market would turn. In the short run, it could go up much faster, but eventually, nothing lasts forever.
Mhm. Mhm. Well, ideally, you don't sell, right? Just because the market drops, you don't want to sell. I mean, you want to buy low, sell high. So,
That's correct.
if you have the money invested in a mutual fund or something like that, and the market drops 40 or 60%, the last thing you want to do is sell. Hopefully, you're not in a position where you have to liquidate for some reason or another. But and that's the mistake a lot of people make. They panic sell, and they say, "Oh, I just want to get out. I can't sleep at night," and that's one of the reasons. Actually, real estate's nice because it's illiquid. You can't just
Hmm.
panic sell when the market's down or the project's behind schedule or something. You got to stick with it and wait for better days, and that tends to be a better investment strategy. Time tends to heal all cycles, right? And then you find yourself at the top of another cycle. So, um, but yeah, I mean, right now, we've had growth. If you invested 5 years ago in the stock market, you would have grown almost 20% a year, depending on the mutual
Yeah.
fund you're in. Let's just say you have a mutual fund that rides the S&P 500, like a lot of mutual funds do. You would pretty much grow like 16 to 20% a year for the last 5 years. So your 100,000 would be like 200,000. And then if you saw like a 30% drop, which I see that the pandemic, wasn't that the last time the market really dipped? Was that considered a recession, or it was so short-lived that they don't consider it a recession?
Yeah, I think it's still considered a recession. The stock market did drop 30% during March of 2020. And like you said, I call it actually the cardinal sin. So the cardinal sin of investing is actually selling when the market is panicking. So you definitely want to
Yeah,
be doing the opposite. And that's what I did during 2020 as well as 2022. We picked up a lot of bargains during that time, and those have grown significantly, more, some of them more than the 20% per year. And so
sure.
that's definitely what you want to be doing. And just given the current market situation, I'm not advocating an all in or an all out approach. I am just recommending something like, if a person's allocation, normal allocation to stocks is 60%, maybe they should be just 50, so that they have additional gunpowder to fire when eventually the stock market will drop. And again, we don't know when that would be.
Yeah, it's hard to time the market.
No,
Absolutely.
it's hard. Yeah.
Yeah, I mean, right now what we're seeing in real estate's on sale. I mean, there's more deals out there than our team even has time to underwrite and buy. I had another broker just call me right before this podcast, another deal here, deal there. I went and saw one today, and It's just crazy. Real estate's on sale. The prices have dropped 20% over the last 2 to 3 years in commercial real estate. Not residential real estate, but commercial real estate here in Jersey. The price of rent is skyrocketed. It continues to grow 5 to 6% a year. We are coming off a crazy time of rent growth from 2020 to 24, and again, we continue to see healthy growth in rent. So the income on these properties is up. The price of the assets is down. Now, sure, the cost of debt is more, but it's actually come down a little bit over the last year, so it's starting to trickle down, and we do expect rates to come down in the future a little bit more, although we don't underwrite with that assumption, but personally, I think that will be the case. So I don't know. Right now, I feel like it's a great time to be buying commercial real estate, especially apartment buildings with the place where residential rent is. And a lot of people are kind of moving capital, taking some chips off the table, as they say, in the stock market and moving into alternatives. What I noticed too, a lot of family offices and ultra high net worth individuals invest primarily in alternatives, real estate, private venture capital, and so on. What are your views on investing outside of the stock market? Do you think people should have more alternatives in their portfolio? What are your thoughts on that?
Yeah, I think that everyone should try to broaden their horizons and look at everything. And they should go after the investment asset class that gives them the best risk adjusted reward. And so if that's real estate, go with a lot of real estate. If that's some alternative mutual fund, then go with that. So I would say it depending on the market environment, depending on the prices, go with whatever offers you the best risk adjusted reward, no matter what asset class it is.
Yeah, I agree. Yeah, we see and then what about the old fashioned 60/40 bond structure? They say it's
Yeah.
dead, right? Is that old news? Does that work anymore? 60% in equities, 40% in bonds. You don't have to think about it. That's just how you kept your asset portfolio for years. Is that dead, or is that still a smart way to invest?
I don't think it's a smart way to invest going forward. And the reason for this, and actually back in 2019, I was telling my clients that for all of if you have any bond funds in your 401k, sell all of it and put it in a money market fund. And the reason for that is that in a rising rate environment, bond funds are going to get hit. And now bond funds are actually very different than individual bonds. Individual bonds, as long as you hold them to maturity, there is no interest rate risk. But with bond funds, because there are so many bonds in one fund, if interest rates go up, the price of the fund actually goes down. So when 2020 hit and that I saw the seeds of inflation, I continue to tell people, you might get an extra 1.5% investing in these bond funds, but if interest rates go up, you're going to get hit. And in 2022, we actually saw interest rates move up, and the average bond fund was actually down 20%. So for those people who were trying to get just 1% extra for like 2 or 3 years, they lost 17% more on average, and that's not a good place to be in. So I would say that the traditional 40% bond allocation, it would make better sense if it were individual bonds, but most people and advisors, they just invest their clients in bond funds because it's easier. And I think that if people were a little bit more educated, it's not that difficult to trade individual bonds. I help people do this all the time. And as for the 60% stocks, I think that I would say that during the middle of the cycle, it totally makes sense for the average person with an average risk tolerance to have 60% in stocks. But as I mentioned on the top of the call, you have to reallocate that depending on market conditions. If market conditions are expensive, you want to have less than 60% stocks. And if market conditions are cheap, like we both talked about, you want to have more. And so 70%, 80%. And if it were like a 2008 scenario, which I call like a real correction, then you want to have as close to as much as possible, as much risk as you can take.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com.
Yeah, it's interesting. Yeah, and we love money market accounts. When we're buying a property, we're holding a few $1,000,000 for a 30 to 60, 90-day period. And we work with different banks. Right now we work with PNC Bank. We get about a 3.8% rate on that, which isn't bad. It's completely liquid, high
Absolutely.
interest savings account. Yeah, the more money you put with these banks, the better they treat you. And it is it's not fixed, of course, so it does fluctuate, but for the most part it goes between like 3.8 to 4 or so. Yeah, it's not bad. If you have $3 million sitting there for 90 days, you're waiting to close, it's a few $1,000s extra that we disperse out
Yeah.
to the investors on a quarterly basis. So the money's not sitting there doing nothing. At least it's making almost 4% or so, and beating inflation, or at least keeping up with inflation. So that's something we do for our investors. But yeah, I actually like the money market strategy. There's nothing like a high interest savings account just to kind of keep your emergency funds in. I remember before I was a well-educated investor, I kept as part of my emergency funds in the Voyager app with in cryptocurrency. My confidence in cryptocurrency was so high at one point that I thought it was a good place to keep emergency funds. I had additional savings and everything like that, but I was like, this is like a bunch of cash I have here. I'll just grow it in crypto. I just thought it would go, wow. And then Voyager filed bankruptcy. We lost a little bit of it. So anyway, it's a crazy, you got to remember, emergency funds means you don't invest it. You don't invest it. That money stays in a high interest savings accounts. You can access it anytime. And I learned that lesson the hard way as a younger man. Absolutely. But what do you so you also advise people on the financial advisor level? What do you suggest to your clients to keep as emergency funds?
Yes, definitely. So one is the money market that we just talked about, high yield savings account that are FDIC insured. And the other thing is we try to ladder out treasury bills and treasury bonds. So we try to have a treasury bond maturing probably every month or so for their short-term cash needs, and then every year thereafter after the first year. So every so often there's going to be some infusion of funds that they can access for their daily living expenses.
That's interesting. Okay, I like that. Yeah, treasury bonds are about as safe as you can get. They're backed by the government, so if they go south, we kind of got bigger problems than
Absolutely. Yeah. If they go south, the money in our banks could be worthless. And the treasuries actually pay a little over 4%. So they do pay a little bit more than the high yield savings accounts, which are nice.
Okay. And you can lock in that rate, right? So that's what
you can lock in that rate for a specific time period. Yes.
Right. That's good. Yeah. So let's talk for a second about interest rates here. You talk about Jerome Powell being let go here. When is his term up? When was that again?
It's May next year.
May of next year. Okay. Yes. So that's gonna be interesting. I think he'll be replaced with someone probably more bullish on lowering rates, is the word on the street, right? So I think people are expecting rates to kind of start to come down then halfway through next year. Although the Fed chairman doesn't really make that decision. There's a board, but I suppose he could try to influence towards that.
Yes.
Is that right? Yeah.
The chairman usually dictates the flow of the meetings, the tone of the meetings. So definitely his stance will influence some of the opinions of the members of the Fed.
And even when a new Fed chairman is named and ready to come in, that'll even that new guy is going to be kind of the voice of reason anyway. Jerome will be a lame duck at that point. When do they usually name a new Fed chairman if they're replacing the current one?
That's a good question. I'm not 100% sure, but I believe that they will name it probably a month before
Okay.
Jerome Powell's terms ends.
All right. So not
Yeah.
too much time for. Okay, interesting.
Yeah.
And all right, so now let's say, fast forward a year from now, we have a new Fed chairman. He's bullish on dropping rates and rates beginning to drop. What's your advice at that point? What is some good stock picks if rates are dropping at that point? What's a good structure strategy then?
Yeah, I think that you want to actually get in before rates drop. So not when rates are actually going down. So you want to anticipate before the market action happens.
Mhm.
And if you do anticipate that if it does come to fruition that interest rates are going lower, what you want are more growth oriented stocks like technology stocks. You also want to have sectors that benefit from lower interest rates like real estate
Mhm.
would be a good example as well. So I would say, and you would also want to invest in companies that are very strong but have a lot of debt, because if interest rates go down, then they can refinance their debt at lower interest rate levels, and that will boost their profits. So
Yeah.
those would be my primary recommendations.
Okay. Okay, that's interesting. And what do you think about, do you prefer to invest in like the S&P 500, or are you also into like smaller companies that are kind of emerging companies, the small board? You ever get into small cap stocks or mid cap stocks, or what do you usually focus on?
Yeah, so I actually focus on individual stocks, and I
Mhm.
normally have around 15 investments at a given time. But when markets are expensive, I have less than 10. And when markets are super cheap, I have almost 30. But again, I average normally 15. And I go all over the place. So similar to my advice to your listeners earlier, where you want to go where the best risk adjusted reward is. And that's the same as me. If the best risk adjusted reward propositions are being offered in smaller companies, that's where I go. If it's in Japanese companies, that's where I go. So I compare all the stock universe to each other and go wherever the best risk adjusted reward possible is being offered.
Interesting. Interesting. All right. And what are you seeing now with the recent tax bill that just passed? That I know for real estate, it's been great. That we have 100% bonus depreciation is back. So now when investors invest in our deals, they can get a 50% tax write-off in the same year they invest, which is incredible. A lot of our investors I've been speaking to recently, they're saying, wait, if I invest $100,000, I get a $50,000 tax write-off in the year I invest. That's amazing. Sign me up. So that's been popular here recently. What impact do you see the new tax bill having that was just passed on the stock market, if it hasn't already?
Yeah, I think it's pretty much all priced in already. I
Mhm.
would say that longer term, the last year, the federal budget was at a deficit of about 6.4% of GDP. This
Mhm.
recent tax bill puts the deficit to about 7.5% of GDP, approximately. And that's actually a positive for markets, because the more spending is being done by Washington, the more buoyant the economy will be. So that's actually a good thing for the short term. But for
Mhm.
the long term, 7.5% of GDP spending is unsustainable. So the
Mhm.
only two times in recent history, and when I say recent history, the last 25 years,
Mhm.
the only two times where we've spent more than we're spending today, and I mean the US government, is during COVID in 2020 and also during the depths of the financial crisis. So, in other words, the government is spending as if we're in a recession.
Mhm.
And that's one of the reasons why the stock market has done as well as it has. Is number one, the government spending a lot more than normal. Number two, there is a lot of money supply because of the Fed. Number three is the low interest rates that we've seen from 2008 until 2021. So, because of those three main reasons, the ride upward has been extremely strong.
Okay. Wow. And then what's the plan here? We just keep on spending like a drunk sailor here in the US. I Doge was supposed to, kind of help us with our spending cuts, but I think their impact it's, it has some impact, but still yet to be seen. And also, I think they're realizing how hard it is to cut spending in Washington.
It's super hard.
Every senator is like, well, let's cut spending, just not in my state.
Yeah.
So it's like not in my backyard. So um, I mean, something's got to give, right? I mean, I don't plan on Social Security being available by the time I'm ready to earn. I'm 38 years old. I mean, there's no way Social Security is going to be around in 30 years. So I'm just trying to build a successful company and work hard and own a lot of real estate and make my own retirement strategy, not rely on the government. But, that safety net's important to have for a lot of people. And
Yeah.
so what do you see is the end game with this just rampant spending out of Washington?
Yeah. So it's kind of like the story of Cinderella, right? So Cinderella, she goes to the ball, but the fairy godmother turned the mice to a carriage, to a groomsman. And spending works the same way. It's unsustainable. At some point, the clock strikes midnight, and all of the pumpkin turns to mice. The groomsman turns to mice again, and it's not sustainable. It's as if, imagine a patient, right? A patient getting steroids and antibiotics every day. It's at some point that medicine is going to lose its efficacy. And when it does, the first thing the government's going to do is going to try to pump even more medicine into the system. But eventually the patient's going to crash and everyone has to face the music. So imagine the average middle class American today. I've heard this stat that the average American is living paycheck to paycheck, and half of Americans are in credit card debt. So let's just imagine that for a moment. If let's say that were true, right? And if they keep spending more than what they make, eventually they're going to run out of people, places, institutions to borrow money from, and then they have to cut their spending. They have to default on their loans. The same thing is true with the U.S. government. The U.S. government is the strongest institution in the world today. But if they keep doing this, eventually there are going to be consequences. And history has shown that governments who overspend will eventually have to default on their loans, cut spending, and cut a lot of programs and benefits for their citizens. And that's not going to be pretty. And like you mentioned, Social Security projections are being made right now that Social Security and Medicare are going to run out of funds in the early 2030s. So in less than 10 years, they're going to be running out of funds and they're going to have to cut benefits.
Yeah. Wow, see, that's why you got to get an in-law suite so you can give your parents somewhere to live. Okay.
Yes.
And that's why you want to be a successful businessman like Earl here. So you can get a nice in-law suite for your aging parents. And that would be a nice thing to do. All right, Earl. So how can people reach out to you here? I hate to end on a doom and gloom note here, but I mean, we'll figure something out,
Yeah. Well, let me just say one thing. One thing to keep in mind is that if you have gunpowder ready to fire, meaning cash conservative, and the market tanks, you're going to make a lot of money as long as you buy when the bottom hits. And so that's something to look forward to if you have been segregating money. And number two, just to end on an optimistic note, is that over the long term, 10, 20, 30 years, the stock market, the real estate market are going to be significantly higher than where they are today. So I don't want to leave this podcast with a doom and gloom message, but I want to end on an optimistic note. And if anybody wants to learn more about me and my firm, you can visit mywealtharch.com/PCF. So let me spell that. That's MYWEALTHARCH.com/PCF.
Excellent. Thank you, Earl. Yes, so Earl's group made a specific website for the passive cash flow listeners here. And I appreciate that, Earl. You can go to his website there and learn more about his company and their past performance and what he offers all of his clients there, which is always interesting. And Earl, one more time, what's that website?
Yes, it's mywealtharch.com/PCF.
Excellent. Well, thank you, my friend, for coming on the show here. And to our listeners who are gaining value out of this, again, we're on YouTube, we have hundreds of videos there. We have webinars, we have tips and tricks for real estate investors, and check us out at People's Capital Group on YouTube and also peoplescapitalgroup.com. We have ebooks and 7 red flags for investors, different white papers and things like that that people can enjoy regarding real estate investing. In fact, one of the more popular webinars I just did was called Your Guide to New Jersey Real Estate Investing. It's here at People's Capital Group. We focus strictly on New Jersey. We've been doing this about 13 years now, helping people build and preserve their wealth through New Jersey apartment buildings. And my business partner, Seth Martinez, and I have completed about 280 transactions here in Jersey. So very active businessmen here. We like to really help a lot of people in the tri-state area, but really all around the country as well. So if you want to learn more about our current opportunity, which is located in Hackensack, New Jersey, next to the #1 hospital in New Jersey, take a look at our website, peoplescapitalgroup.com, or get in touch with our team there. We'll reach out to give you some more information. Earl, I appreciate you coming on the show, my friend. Thank you so much for your time.
Thank you so much for having me. It's an honor to be on your show.
Thank you, my friend.